Hello and thank you for joining us on our continued educational journey through surface preparation. My name is Kevin Hawthorne, and as always, I'm joined by our resident subject matter expert, industry patriarch, and substrate technology president, Josh Jones.
Hello and welcome to episode 8 of BMD Presents Execs and Techs. As we begin a new year, many of us are contemplating upgrading our fleet and purchasing new equipment. After you've invested the time and completed your due diligence in making that purchasing decision, it's time to consider that topic many contractors try to avoid or even consider taboo, and that's financing. Today, our goal is to break down financing into an understandable, user-friendly conversation. And here to help us do just that is Senior Finance Specialist Jen Griziolia. Many of you may already know Jen, as she's been financing surface preparation equipment for contractors for over 12 years and has worked in finance since 1995. She's a staple at the world of concrete, works directly with some of the largest distributors in our industry, and is considered one of the industry's most experienced finance professionals. Jen, thanks for taking the time to join us today on Execs and Techs and answering some questions, as well as clarifying some of the most common misconceptions as they relate to equipment financing.
Good morning, Kevin and Josh. Thank you so much for having me. I look forward to talking through finance and letting people know, some more information about that.
Jen, let's jump right into the heart of the conversation. If I'm a contractor and I have cash, please explain to me the advantages of financing a piece of equipment over versus simply writing a check.
Well, there's a couple reasons. So financing will allow you to build business credit, whether you're a small business or a large business. You want to make sure that you have business credit just like you have personal credit. That's very important to have for future borrowing. The second reason would be to preserve your cash. In today's environment, what we're going through right now, we want to make sure that we preserve our cash for payroll, building expansions, utilities, things like that. So financing your equipment will kind of save some of that money for those other things that you might need it for.
Josh, as a former contractor, what are your thoughts as they relate to accessible cash flow for items such as payroll and other operating expenses versus writing a check for a piece of necessary equipment? Does that tend to stretch your cash funds?
Speaking from experience as a contractor, cash was always tight. Payroll, Jen had alluded to payroll. That's probably the single biggest expense that we had as a contractor. When it came to expansion, we didn't really need infrastructure or facility, but we did need equipment, not just consumables for the jobs, which, we might wait 60 or 90 days to get paid, but we had payroll to pay every week. And so, cash was always tight because money's always going out and it seems to take longer to come in.
Jen, as a consumer, I'm always concerned about my credit score. I assume you guys are required to conduct credit checks. How does that affect my credit score, or how does that affect my ability to get a loan?
So really, based on how long your business has been around, will depend on whether or not we have to look at your personal credit. If we do look at your personal credit, it is a soft credit pull, and that means it does not affect your credit score at all. It does not appear on your credit report that we looked at your credit, or any kind of debt appears on your credit. So it can't hurt you to pull your credit, and it might even help you because maybe you haven't seen your credit score in a while, and by us pulling it, we're kind of able to go through that with you a little bit.
Josh, in your experience with financing, have you ever experienced any negative effects to at least going through the process of having your credit checked prior to a loan?
No, my personal experience is limited. As a business, as a small business, we didn't have a lot of experience with financing either. I think where I would probably have the biggest hesitation is the fact that I'm giving my personal information and having that checked out. Jen alluded to, soft credit pull. That's a new term for me. When it comes to having someone else checking out the credit, I just would want to feel comfortable that, it's going to be treated with my best interest in mind. I think that's probably the biggest hindrance. For some reason, it's easy for me to walk in and buy a car, maybe because I trust the brand. But when it comes to equipment, if I'm walking through a trade show or whatever, and I know I need to buy equipment, I think my biggest hesitation would be, having people looking at my credit. So I don't know if that answers the question, but that's my personal hang up, I think, with turning over my numbers to have somebody look at my records.
Another common question we get, Jen, has to do with explaining the difference between a lease and financing equipment?
Sure. So financing equipment, that allows you to finance everything: consumables, sales tax, shipping, everything all in one. And the customer owns the equipment from the beginning of the contract until the end. On a lease, so when you sign your contract and you have a payment on the contract, what comes on your invoice is the exact same payment. When you do a lease, that is without tax. So you'll sign a contract with $500 payment. We own the equipment the entire time. And then at the end, we turn it over to you, but your payment will include sales tax on the invoice. So the payment goes up a little bit. So it's just more of a transparent, clean contract when you do it as a finance agreement, which is typically 99% of what we do.
Jen, I'd like to talk about startups. At some point, we've all been a startup, and many of us at that time either have very limited cash resources or we have very nominal credit established. Are there finance opportunities for those who are just getting started?
So we realize that, startups need equipment. So we are able to finance startup businesses. Obviously, we do require credit pull for the personal guarantor or the owner of the business. We require a little bit, the credit requirements are a little different for a startup. Credit score has to be a little bit on the better side because there's no business credit. And our maximum amounts that we can approve may change. But in my experience, startups, I do a lot of startups and we haven't had any issues with getting them approved. And again, we're going back to building business credit. So in a year when you go to do this again, it's a lot easier because you will have now established your business credit.
So Jen, one question is, based on someone's credit score, does that determine their interest rate? And can their interest rate change throughout the life of a loan?
Well, the interest rate depends on a couple things. Yes, it does depend on your credit score. It also depends on the term of the loan and how much you're financing. So it's kind of based on a couple different things.
So Jen, would you encourage someone to apply for financing even with limited credit because they're new, or maybe they don't have the most stellar credit from the past?
Absolutely. I encourage everybody to at least try because it's not going to hurt you to try it. It doesn't affect your credit. And, you might be considering buying a $20,000 machine, but if you get approved for financing and the payment is doable, you might be able to buy a little bit more equipment. So I definitely try, startups or existing, always give it a shot. Definitely.
Let's move beyond the application process and into they've been approved and they own the equipment. Are there any penalties for early payoff? And if so, are there advantages to paying off a piece of equipment early?
So we do have an early payoff option. Basically, it's similar to a credit card where you're paying off the principal balance after however many payments you've made. And there's a small fee based on when you pay off the contract. So for example, if you have a 4-year contract, you want to pay it off before year 1, we let you pay the principal balance and then a 5% fee. So the advantage to paying it off early is obviously to pay off and get it off the books. But you still have the advantages of keeping it for 4 years. If the job doesn't pay you on time or whatever, you still can make that monthly payment for 4 years.
I know how it works when I buy an automobile. If I buy an automobile and it's a 5-year loan and 3 years into it, I decide I no longer want that car and I want to sell it, I'm required to pay off the car in some form, get the title before I can then sell it to a third party. How does that work with equipment? If I've borrowed $25,000 and bought an STI grinder, and 3 years into it, I want to upgrade to a bigger grinder, but I need to sell my existing one first. How does that work if I still owe money on it?
So that's another reason why we do it as a finance agreement, because you own the equipment throughout the term of the loan. So if you decide to pay it off, we do expect the contract to be paid off. So you have option 1 would be call in, get a payoff, and close it out. The other option would be to have the new owner of the equipment apply for credit with us, and we would do what's called an assignment, and we would switch the loan over to the new owner's name. So there's a couple different ways they could do it.
Good. Kind of a silly question, but what if my equipment is stolen off a job site, or what if it's damaged in an accident and I still owe? What's the process then?
So we do require insurance on equipment. Typically, if you have your own insurance policy, when you finance equipment with us, all you have to do is call your insurance agent and add the equipment to the policy. It doesn't cost you anything else. We do offer insurance. So if you don't have insurance, and some startups don't, we will offer a monthly insurance premium so that you guys can make sure the equipment is insured. If something should happen to it, then you would file a claim through your insurance policy and go through it that way.
Josh, I'm interested in your perspective as a contractor and now as a manufacturer. You've been in the industry long enough. I've been in the industry long enough. There seems to be a negative connotation that's associated with financing, like it's some sort of crutch for a contractor. They're less successful because they have to borrow money as opposed to writing a check. That may be an ego thing. I'm really not quite sure. But from your perspective, can you touch on that a little bit? And is that true? And why is it there? And how do we overcome that? Or how does someone like Jen overcome that hurdle to convince a contractor that borrowing money is actually an advantage to their business?
Well, I think you touched on it. I think for me personally speaking, it would be, I don't want to admit that I don't know what I'm doing. When it comes to buying equipment, if I don't have the cash, but I need the equipment for my business, I need to feel comfortable with whoever I'm working with, that they're going to have my best interest in mind when I say I really need this so I can do a job that's required of my company. I mean, that's my job to make sure that we can do it. But I got to feel comfortable with who's going to be helping me. And I don't know how you break down that barrier, except in my opinion, communication is key. I see a lot of times with a lot of companies that will, and not just this industry, any industry, a lot of advertisement with very little communication, with very little transparency. Speaking as a contractor, speaking as someone who might finance, I would like to feel in the relationship that this finance company is helping me to run my business. If I look at them as something that just takes extra money off of the money that I might otherwise make or be able to reinvest, and I'm paying this interest, I'm obviously going to have some ill will toward that vendor, toward that provider. So again, getting over that emotional barrier, I don't know how you do that, but I will say that the best way to have a business relationship is to have good open communication and making sure that there's full transparency. And I think that really comes down to the way that it's presented to the customer, the way this is going to work, and the more easy the process can be from step 1 to step 20, it's just very transparent and clear. So I feel comfortable. And then I might actually start to realize, hey, I can use another company's $30,000 so I can get the equipment I need to. I keep the cash that I have and I can make payroll, and at the same time, I'm getting the job done. So, it's a lot of psychology there, but yeah, I think as a consumer, we're all consumers. I just want to make sure that, I'm not getting cheated. I hate to say it that way, but I mean, I have a business and I have a responsibility to that business to make prudent decisions.
Jen, with that said, segue into the last question for you is, I'll give you the opportunity to kind of build on that and talk about the advantages or promoting financing versus writing a check. What are some of those fundamental advantages a contractor should know, or at least be aware of when they're buying their equipment?
So when a customer calls me to do financing, I am very clear with my first question to them is, what can you afford per month? Here's what it's going to cost you over 4 years. If you're going to be paying back $50,000 on a $40,000 piece of equipment, can you afford a lower payment and a shorter term? I kind of work with the customer. I'm kind of a consultant, I guess you could say. I'm not just trying to force them into doing a transaction with me. I want to make sure that it does work for them and that they realize that they're going to be paying X amount at the end of 2 years. But they have a job coming up in 6 months that's probably going to pay for the whole thing and then some. So to pay a little bit of interest for 2 years to save your money, I kind of work with them and let them tell me what they need, and then we work around, we structure it around what works for them. So my job is sort of a consultant for these contractors. So I'm not here just to say, here's the monthly payment, do you want the equipment or not? I want to make sure that I work with them to get the monthly payment that they need that makes sense for them so that they can grow their business. If there's a credit issue, I do work with them on their credit reports to make sure that we can kind of figure out the items on there that are keeping them from getting approved. And then next time we can move forward because these things have been taken care of. So it's almost like I work for them. I help them feel comfortable with borrowing money and buying equipment not through cash and using the finance option. So it's, I kind of make them feel more comfortable with me before we just jump right into the numbers.
Well, once again, this has been a great discussion. And for those of you who'd like to learn more about financing, I would encourage you to reach out to Jen either by completing the loan inquiry form on the BMD webpage or by contacting Jen directly.
Thank you in sharing in our discussion today about equipment financing. We'd love for you to subscribe to our YouTube channel to check out other informational videos, as well as be notified when we post a new episode of Execs and Techs. You can also catch our audio version wherever you stream your favorite podcast.